Hello, this is Gabriel Shaheen, Certified Financial Planner and President of Falcon Wealth Planning. Today, I wanted to go over with you the current market events that are happening and the adjustments you're seeing in your portfolio. As currently, the S&P 500 has hit bear market territory with the 20% drop. In addition to that, the NASDAQ has fell into crash territory with a 35% plus drop in those markets as well. We are seeing significant volatility right now. And a lot of this is derived from the rising of interest rates. The Fed's raised rates 75 basis points yesterday. Now, the problem with that is today the market dropped with the new fears of a recession, where yesterday, with rates going up, the markets went up. Why did the stock markets go up yesterday? Because it's right on track with what everybody expected the Fed to do, which is a 1.5% increase for 2022. So what does this mean for you? Well, the few things is, you have to understand the risk reward feature of investing. It's very rare that stocks and bonds drop at the same time. It's not a normal occurrence, which I'll go into with the deck that is attached to this email. The important parts of that is the risk and reward side of it is there are risks to investing. That's losing money. We get that. We understand that. But don't forget the reward piece of it. You make money, especially in markets like this. So we are taking proactive measures in your portfolio and buying on the dips. And right now we are making changes in the portfolio. These are times where we like market sales. It's one of the few industries out there. People get upset when the market is on sale. If it's down 20%, any other industry, you'd be happy. This industry, some people freak out. And I understand the sensitive part of it. With your money, you're seeing money drop. Just know we've seen this movie before. The thing is, we know how it ends. We're just at the scary part of this movie. Now, when you compare it to what happened in 2020 during the COVID crash, it dropped 35+% in just a 4-week period. Here, it's down 20%. It dropped more during COVID. So now we have to realize that what we've seen it before. We cannot react negatively. When you understand and take a look at where we are today and you look at the current markets and the way they are handled, it is very important to know that the average return after a market increase of over 50%, it went up higher than that, went up 75 basis points is what it did. And so is historically the returns on there are 20% in stocks and 13 to 14% with bonds. Now that's historical, right? You can't make decisions based on history, but you can use it as a lesson. There's no guarantees. The point is, why would bonds go up? Because of stability, because of repricing that happens. So you have to be aware and not overreact. When you look at the average 6-month returns from the stock market, you're looking at about 9 to 6% on the bond side. And this continues as we are looking at it. Most of you have a globally diversified portfolio. So when you look at 60% stocks and 40% bonds, we're at the third worst return in the history of a diversified portfolio. Now, when you look at the 2 worst times above that, the next 7 months and 12 months had really good returns. And historically, they average out to get you that 10% and 13% over the next 7 and 12 months, respectively. I'm not trying to say there's guarantees, but just know when those are fearful, like people now, that's when we're greedy. This is when we take advantage of these volatile times. Bonds is the worst performing start to a year ever. And this was up until the end of April. But when you look at historical, when you look at the first 4 months, and we've had the worst 4 months history, historically speaking, we've had very good returns afterwards. We are in a rising rate environment, and you are seeing short-term treasuries now out yielding long-term. Just in general, it's not normal for stocks and bonds to drop together. You can kind of see it here. It's probably happened 25 times, as you could see, in our history. But understanding where on the stock side these losses are coming from, most of it is from individual stocks. Majority of the losses, about 40% of them, come from the largest companies out there versus when you look at globally diversified portfolios, which is what most of you are in. Most of you are in an allocation that's not 100% stock. But when you look at the largest 5 companies in the S&P 500, look at the losses that it's representing. Now, granted, this is at the end of May, and it's even worse than that now at over 30 to 40% losses. So my point to you is, when you look at the next 15 largest stocks, it's only down 1.5%. When you look at the next 80 stocks, it's down about 10%, and the remaining 400 stocks in the S&P 500 down almost 7%. So majority of these losses are coming from something similar to the dot-com bubble, which is from these large overpriced tech companies. Granted, these are profitable companies, but my goodness, they were overpriced, let alone the rest of these tech companies that were also much more overpriced. And there are multiple sectors in here. And one of the sectors we invested in, you guys, in 2020 was energy, which yielded to be really good, which is part of the reason your portfolio is not down 20 and 35% respectively, because of the diversification piece. Right now is not when we balk. Right now is when we buy. We see discounts. We like the sales that are happening, and we're starting to see some stability, especially with the 10-year treasury. If you have any questions, please reach out to your advisor. We are here to take advantage of this opportunity that's in front of us. Whether it's 1 month from now, 1 quarter from now, 1 year from now, or 1 decade from now, we are assured that these decisions we make today at the current discount that's here will yield fruitfully. We are confident that you will have more money than what you had when you originally started, because we bought at a lower price. So we thank you for your trust. We appreciate the business. Please reach out with any questions you may have. We look forward to serving.